In today's video, we're going to talk about the most recent Bank of Canada interest rate announcement that happened on September the 6th. We're going to discuss some of its implications in the fall market here in 2023. And we're going to discuss some scenarios if you are an investor considering selling your rental property and some of the scenarios that we as a team are discussing with our clients and helping guiding them through that. If you're new to our channel, my name is Koukun and I'm a real estate investor and I run a real estate team here in the Niagara region. If you're interested to discussing your situation, be it selling or buying an investment property or maybe a primary residence, there's a link in the description below to book a 15-minute call. All right, so let's get into it. So if we start with just the announcement as of September the 6th, you probably already heard the Bank of Canada decided to hold interest rates at 5%. Now keep in mind, they have increased interest rates 10 times since March of 2022. And this is the third time that they've paused interest rates. Basically, in the spring of this year, they had two pauses, which created this fury of demand, especially closer to the GTA. In the Niagara region, we saw more demand, but not quite that multiple offers that we saw in the GTA. Two further interest rate hikes caused the summer to be extremely slow, but this most recent hold is potentially going to have some implications for the fall market. So one of the reasons that they decided to hold interest rates, and a big factor, I believe, was that the GDP data in Canada showed that the Canadian economy actually contracted in Q2. So two contractions in a row is a recession. This was a very small contraction at 0.2%, but it is the first out of two potentially. So that is something the Bank of Canada is very aware of. And they're trying to orchestrate a soft landing, which is to not go into that recession territory. So how does this affect us as home buyers, home sellers, or investors? Let's take a look at some of the data here. So this is for the Niagara region. First of all, average sale prices for August, you can see it's been declining since June. This could be seasonal slowness, but just boots on the ground information, what we have been seeing is that the market has been slowing, and we saw a few transactions where desperate sellers were giving away the property at fairly steep discounts. How this plays out in the next couple of months is yet to be seen, but I'm cautiously optimistic that with this rate pause, there may be some confidence that this is sort of where rates are going to finally settle and maybe come down from here. So some of the scenarios we're discussing with clients are this. If you purchased a property from mid-2021 to the spring of 2022, so if we're looking kind of around here, June, July, August, up to obviously the peak in February. This is, for example, if you have a variable rate mortgage and you need to sell the property because it's no longer cash flowing, it is very tough right now. Basically, what you can see is the average sale prices since about mid 2021 are about the same, if not slightly less, depending on the property type. We're seeing many examples of, for example, duplex conversions, triplex conversions, where a lot of money has been invested in the property, but because of these higher interest rates, there's no guarantee you can get back your purchase price plus the cost of your renovations. If you're in this scenario right now, what we're recommending our clients is to simply hold if possible. Just kind of try to hold on to the property so that we can get to a time where interest rates are maybe lower and a bit more stable, and then you can look at selling. If you purchased a property prior to 2019, and 2019 is a key date because you would be sitting on a decent amount of equity, assuming you haven't refinanced the property. But even if you had a fixed rate mortgage, you're likely coming up for renewal. Either you already, or maybe you're coming up to it in the coming year. In that scenario, depending on your overall portfolio, if you have a few properties where, say you have some properties you bought in this time frame where you can't sell it, it may be worth considering selling the properties you bought prior to 2019. If it's coming up for renewal, the cash flow is going to be squeezed, but you can get a decent amount of equity from the sale, use it to reduce some of your other debts, or just give yourself a liquidity buffer. That is honestly not a bad scenario to consider. I'm personally kind of in that camp right now where I'm selling off a couple of my rentals, and this is kind of the thought process for me. Some of my properties have built up some equity, and I'm trying to get my portfolio to a size where it is a amount of properties that I can hold on to for the long term. Now, the next scenario that includes basically all of these timeframes is if you have variable rate mortgages, and especially if you've been refinancing properties at higher and higher appraisal values, pulling out the equity and buying more properties, you can be in a very tough spot, especially if those mortgages were with Scotiabank where the payment resets each time these interest rates have gone up. In that scenario, you may have bought properties at these lower prices, but your mortgage may be 80% of the higher values that you've been able to refinance. And across your portfolio, you have a fairly high debt amount with now high payments because of the resetting of payments. This is a time to really do a introspection and just take a look at your portfolio, take a look at your personal finances, and just make sure, is the amount of properties you have a comfortable amount that you can hold on to for the long term? Because if you have a portfolio that is now over leveraged where the cash flow is being squeezed and you're really in a tough spot, even if you're not able to make that much from selling some of your properties, it may be worth considering to do it just so that you shrink your portfolio to a size that you feel comfortable to hold on to for the long term. The final scenario here is, opportunistic selling. So we saw this, for example, in Hamilton, where the market has been fairly more active than some of the other areas we operate in, like the Niagara region and even, close to the GTA in sort of Mississauga side. For whatever reason, the Hamilton market has been a bit more resilient, and, we've seen properties going to multiple offers first in the spring market, and even as other areas cool off, we've seen a bit more activity in Hamilton. So if you, for example, have a portfolio of properties where some are in Hamilton, some are in Niagara, some are in the GTA, you may want to consider selling the property that is in the more active market if you're in, the previous scenarios, whether the property was bought earlier where there's some equity, or if you have some variable rate debt you want to get rid of. It may be worth looking at what is the better property to sell that you can get the better sale price for. Now, going back to the fundamentals of real estate, I personally believe that real estate will still be a great investment, over the next 5, 10, 15 years. Immigration is continuing to increase, the demand for housing is really high, and there's not really much of a production in terms of the creation of supply of housing. That being said, even a great investment can become a bad investment if you are over leveraged, if you're in a position where you own too many properties with variable rate debt, where you cannot hold on to the properties during tough times. That is one of my biggest learnings in this past year, where I realized that, quite frankly, I had too much variable rate debt and just too many properties that I don't feel that I'm in a comfortable position to really hold on to this portfolio for the long term, which has led to me making some decisions to sell some of my properties so that the ones that I keep, I can really hang on to, regardless what the Bank of Canada does, regardless what happens in the economy, inflation, recession. Like, I want to be in a position that the properties that I do own, I can keep, and I can really receive those long-term benefits from real estate. So if you're in a similar situation, definitely something to consider. There's nothing wrong with selling a property when the facts have changed. So if you're buying a property that was yielding like a 5% return and you were borrowing at 2.5%, back then that was a great investment. But that same property now, if it is costing you 6 or 7% to finance it, and if you're in a tough position as a result, it may be worth reconsidering. Can you survive long enough to receive the benefits from that investment? And if you can't, then I would urge you to consider selling some of your real estate to be in a position where the remaining properties you can hold on to for the long term. Hope you found this helpful. If you have any questions, feel free to comment below or book a 15-minute call where we can discuss your situation in particular. And if you're interested in investing in the Niagara region, check out our beginner's guide to investing in the Niagara region. We also have a top 5 mistakes guide when selling your rental property. So if you're considering selling your rental property, it is also in the description below. We have sold countless investment properties, and we've bought countless investment properties that were being sold where these mistakes were made by the other side, allowing us to get a good deal. So if you are going to sell your property, you don't want to make those mistakes so that you can get the maximum value from these properties, especially in a market like we are today, where you may not be making a whole lot of profit when it comes to selling your rental properties. Hope you found that helpful. Until next time, all the best.